Hey everyone, welcome to Tuesday. Gosh, it's the 16th of June already. Can you believe that? And we're still talking about PPP, and we're going to be talking about Main Street Lending Program today. And Adam Boatsman has his OK I'll Know t-shirt on, giving a shout out to the you'll have to do the Superman post on that, but to give it a shout out to the Clean Juice guys, and Jack Santaniello is back again, which is awesome to have both of you guys on. So we'll be talking about both Main Street lending program as well as PPP Flexibility Act and anything else you guys want to talk about. So go ahead and hit the Q&A button, and don't use the chat for anything other than to harass us. And I'll go ahead and pass it over to Jack if you want to do a little preamble, and then we'll go to Adam and then go into questions.
Sure. So the intention today is to, as I put in my LinkedIn, to take a detour off of PPP lane and get onto Main Street, at least for a little bit, and enjoy doing this because it keeps me on my toes as to trying to figure out what all this stuff is. It's isn't easy to kind of put it in the background because we're focusing on PPP, and really the Main Street program really hasn't come fully online yet. So it's, if you don't have to fill your brain with those neuron or those memories or that knowledge, then you kind of punt it. So it's an appropriate time to chat about it because there is, I think, a misconception that the Main Street loans are for not for me, that it is in a different stratosphere of lending, of business size, of number of employees, and that's not necessarily the case. And so you guys know that I don't like to read things, but I think it's just really the easier way to at least introduce this or expand on what people's knowledge of this is. So the Main Street Lending Program is a $600 billion fund designed to encourage eligible lenders to make new loans or expand loans. And so what happens is the Fed creates this, what's called a special purpose vehicle, and they dump some money into the program, but it really is funded by eligible lenders, so your banks. And I have some slides which I will queue up while one of you guys is talking, because I have a gazillion screens up and I need to find where it actually is. The slides are on my computer. But it's basically in return, the banks, in return for funding essentially 95% in most cases of the loan. I'm sorry, that the Feds, that it gets funded, and the risk is only 5% to the lenders essentially, so they retain that risk. And then there's a priority program where the risk is, more of the risk is assigned to those banks. So and I have some charts that will go through some of that and some further explanation, but really it is a pot of money that was created for, and we can go through the eligibility requirements. The slides that I have, I will not claim authorship of. I did take one from an article that I found, another one from JP Morgan, and another one from RSM, so from McGladrey. But they looked really pretty, and so I wanted to show them to all of you. And it's a good explanation of what these programs are. So I will turn it over to you guys for a moment while I find those slides, and then maybe we can cue them up on the screen and we can go through them.
I'll make you host as well so that you can share your slide. So go ahead. Adam, you got anything that you want to add to this so far?
No, I thought we would just sit in silence. If you could put the screen back on Jack while we watch him wait and scramble. I'm stalling for time now, Jack, so you can say something.
I'm already sweating. Don't make me sweat more.
Yeah, exactly. Having not had the benefit of seeing Jack's slides, again, who knows with all things government related, hitting on the Main Street lending program, why things are the way they are. But effectively, this was meant to be extended credit facilities to encourage banks to continue lending without taking on without taking on all the risk. Because if you think about what we talked about this in the last webinar, and I need to stop saying that. It feels like saying or whatever. It's my crutch word. So if someone on the chat could start keeping track of how many times I say in the last webinar, just kidding. Yeah, there we go. Now I can cheat off this. You know, if you think about what would likely happen with banks, and we've already started to hear this a little bit, is that if banks have to take on all the risk of continued lending right now, sure, we can make the application for credit and say, hey, there was this one-time blip of coronavirus that caused a downturn and we expect the future to restore to blah, 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 blah. Well, if you think about the only time in our recent past that we have experience with that same set of circumstances, it was really the Great Recession. And in the Great Recession time period, what happened is that credit effectively froze for several years. So when the spigot got turned back on, you know, they would discount or at least do some add backs back to Great Recession times, so kind of that 08, 09, 010 time period. But they weren't really loaning again until 10, 11, 12, you know, unless you had a perfect set of circumstances, in which case you probably didn't need the money in the first place. So it was hard to get people funded during that time frame unless you either were already a super strong borrower, and the only exception to that would have been, man, you got a great track record of this really was a one-time blip, and there weren't really a whole lot of air balls sitting in the credit file. So in this particular case, you know, speculating a little bit out of the Federal Reserve is that they don't want to have to wait for 2 years for businesses to start showing the track record associated with some sort of improvement or some sort of, hey, COVID was a temporary blip for me. You know, look what's really happening in reality, because a lot of the loans that are going to happen now are really speculative based on what a recovery will look like. So this is the Fed's way of saying, hey, let's keep the spigot going, but we got your back in terms of making sure that your risk exposure, you know, isn't out there. Because if the risk exposure was completely on the banks, then, you know, the likely answer would be, hey, let's hunker down, focus on the credit quality of our existing portfolio and make sure those loans are performing, and kind of freeze new credit. And we've already seen that in a lot of cases where, you know, people aren't getting lines of credit increases. You know, people aren't getting new loans done because everybody's just focused on the here and now. So all that said, you know, this program has 3 different programs within it. So it's a program with three different programs. One of them is new. It's really one program, 2 programs with 2 variations. So one program is brand new loans. So in this case, you know, hey, I want to get a new loan. Bank's worried about making it. Fed's got your back. You know, there are some lower and upper limits associated with that. But basically what it looks like is these are cash flow driven loans, because other than the size restriction, the only covenant calculation is effectively a fixed charge covenant, which basically means that total funded debt to EBITDA, and by funded, you know, this is a really strict definition that we haven't had to deal with a lot when we're looking at borrowing covenants. Funded debt in this case actually relates to unutilized credit, meaning like if you had $1 million line of credit, but there was $0 on it, that still counts as $1 million for the purpose of this calculation. They're going to assume that you maxed it out. So in the new loan scenario, that's 4 times funded debt to EBITDA. Ooh, Jack did have a slide. I'm looking at it right now. You can go back to the other one here in a second, though. In the other scenario, you know, basically it's loans made after April, whatever it is, 24th, or loans made before April 24th. In loans made after April 24th, this is, you know, expansions of loans that the bank made after April 24th that you want to make bigger. In the case of pre-April 24th, it looks like this is an expansion of loans made before April 24th that the bank wants to make bigger, not, huge variances between the two. But, there are some other restrictions. So with that in mind, I'm going to go ahead and turn it over to Jack. But, effectively just remember that, this is really a way to still have credit flowing while businesses haven't necessarily had the performance to support it based on, based on what's happening in coronavirus, other than the fact they're still going to have to hit a funded debt to EBITDA covenant. So with that in mind, Jack, go.
Sure. So I don't know if me talking triggers the that people can see on what's on the screen. I'm going to assume so, that people can see what's on there because I am sharing it.
I can see it, Jack.
You guys can see it? Yeah. Okay. All right. So just as a point of comparison, the SBA Paycheck Program, and I note that this is probably a little bit of an older slide because it actually isn't 349 at this point. It's actually 659, 660 because there were two tranches that were installed into that program. The 600 billion Main Street, here's the eligible recipients, and then these are the actual numbers. Now, to break it apart to what Adam was talking about was on this slide where it talks, and I would say that, first of all, that as we become more knowledgeable about this stuff, and to my comment at the very beginning, which is, we're learning about this too because it hasn't been in the forefront. So I'm sharing this and not having, admittedly, as deep a knowledge of this program yet as we do, and have been with the PPP. So I'm sharing this with you in that, just to give you points of comparison. So the new loans, the priority, and really it's new loans and expanded loans, and then there's kind of this middle category of priority loans. And part of it has to do with the fact that the new loans are primarily unsecured, and I'll show you that in another chart, unless there's already security in place, and that has to be the highest priority, or at least on equal footing as far as priority goes with the loans that are already there. And so you see that in that subordination section. The next chart, so this is a little more in detail. So it's a graphic representation of how essentially the money flow should go, which is that you have this facility, the $600 billion. And so Treasury throws in 75 billion with the expectation that the banks, there's this liquidity that's inserted. And so what happens is that the eligible lenders, the banks, hold 5% of each eligible loan, and that the Fed commits to purchasing 95% of the loans, essentially, and I believe it's in a guarantor type scenario. And then you have the banks that are issuing the unsecured loans, unless there is again, a secured loan that's already on there. With respect to the expanded loans, well, let me make one very important point, that these loans are not forgivable, first and foremost. So, it's likely, if there's already an existing loan in place, that because this is an SBA program, outside of the 7A, where the PPP was maybe, or I'm sorry, the EIDL was maybe unsecured, maybe secured, this is a little bit different in the sense that if there's an existing loan, the likeliness that it's highly likely that there's already security in place. So there has to be subordination or some sort of sharing arrangement with respect to the collateral, so that the bank's rights are specifically set forth as to who has priority on collateral in case of default. So there are a lot of similar charts out there on the web. I got this one from McGladgery, and on their website, I put the credit down at the bottom because I don't want to get hit with a copyright infringement lawsuit. So if you use it, I would suggest that you also give street cred to the people who produce these charts. So that is kind of a very topical review of Main Street. There is a published frequently asked questions. It's like 70 pages, and it goes through 3 different programs. It does a little bit of comparison with the PPP and the EIDL is kind of where they intersect. It's more specific on eligibility requirements, on all the things that you may want to know about this program if you're interested. And so, I direct you to that.
Good. If you're gonna stop the screen share there, Jack.
Yep.
Yeah, the only thing that I'd add to that is that the only thing that looked a little bit out of date on the slide is I think that the new loan and the priority loan are at 250 now instead of 500. And then the other thing that's not on the slide, but just, I don't know if we have a lot of clients who are in this situation, but the loan has to be performing, meaning the specific criteria, and I don't know what this means in banking term, but it has to be, pass from the bank examiner standpoint. So I think the only thing that we'd have to wonder about related to this is that if you received an abatement from the bank on your existing loan, what does that really mean in terms of their own internal systems? I would speculate that, probably, you'd have to maybe demonstrate a track record of making a couple payments back on that loan to show that you had the wherewithal to pay it in 2020. So just, if you're already struggling and, trying to get a longer abatement than you might have already gotten from the bank, this might be a tough one to get. I really look at this as a loan program available for companies that, are still going to do okay and are doing okay, but otherwise the spigot to credit has been turned off just because the broader risk environment that's sitting out there.
All right, if you guys are cool, I'm going to go ahead and start rocking through some of the questions. And,
okay.
Is that all right with y'all?
Sure.
All right, this one is in from David. I actually got this yesterday, and he has a fractional CFO, fractional controller, and bookkeeping company. And he's also been kind of on the front line on a lot of this stuff, but he raised a few things here that I thought was interesting and would be of interest to people watching this in case they've been hearing some of the same stuff. But he said, I've been saying that nothing in the law prevents you from spending the PPP on any legitimate business expense or not spending it at all. However, I recently read that spending it on non-qualified expenses could constitute fraud. Gulp. Do you believe that there's any basis for fraud charges based on how a company spends the money? Jack, you being the legal authority on this call, can you weigh in on that one?
Sure. So again, Jack Theory, not the official position of this law firm or of the federal government, but I would assume that it's a spectrum, and I think on one end of the spectrum is the obvious and overt fraud where you've paid yourself $100,000 bonus or something along those lines, so an improper purpose in that fashion. I think that if in good faith you're trying to comply with the program and you end up with funds that are non-qualified for forgiveness and that they convert into a low interest loan, then I think that's the intent of the program. If the question is more of should I have received those funds to begin with, then it goes back several weeks ago as to when you created the formula and did the numerics and your spreadsheet in order to apply for the loan in the first place. So there are various points of review as to whether or not there was a good faith intention or true fraud, fraudulent intentions. So I think that's kind of the differentiating factor. I don't think that just because something ends up being in the non-qualifying bucket for forgiveness, that you are going to be dinged or deemed of having committed fraudulent behavior, because it's the intention that money flows, and they have created this regime where there's different, it either is a grant or potentially a low interest, short term, essentially short term now, a little bit longer term loan to the borrower.
Couple more. Go ahead.
I would tend to agree with Jack in the sense that I say 10, meaning there's part of me that doesn't agree. I'm just kidding. I fully agree with Jack. You know, if you just think about, okay, so what's going to constitute fraud? Well, they're probably going to have their hands full with people that just flat out falsify payroll records. You know, so the first category is I claim the expense, but I didn't even freaking really pay it. The second category is I lied and broke the rules. There's going to be probably enough people that fit into those categories before you even get to, wow, it's kind of squishy. Should I have hired the people back or not hire the people back? You know, I didn't spend the money on payroll, but it still kept the business afloat. I really think with the extension of the forgiveness test period to 24 weeks, I mean, they're really trying to make it hard to not get the loan forgiven. So while you hear a lot of people saying fraud, and you'll get, you know, you Google it, you'll get enough. Frankly, they're mostly coming from attorneys, Jack, but enough people saying you got to be careful. And I fully agree with the statement, you got to be careful. At the same time, in some respects, they neutered themselves by saying we're only going to look at businesses above 2 million. And even then, it's just going to turn into a loan. So, you know, it's hard to believe that anything super, super bad could happen other than you have a loan stuck at the end, assuming that you didn't commit flat out and out fraud. Now, all that could change with the change in administration. But I don't know. I don't really see this going anywhere. The lawmakers' attempts to get access to who got funded what, you know, I'm actually somewhat on the side of the administration on this one that, you know, I mean, I don't really know what good purpose that's going to serve other than public shaming, but frankly, you don't know what's going on in my business. So how dare you? So I'm actually on the side of, I don't think, you know, unless you can give me a damn good reason that we ought to be having congressional hearings on that, you know, go after the people that really committed fraud, not the people who made the best call that they knew how to make at the time.
And let me throw in two tangential comments. First is that there's a lot of emotions going on, frustration, et cetera, for a number of reasons. One related to COVID and generally speaking, health-wise, how that impacts our business world. And then there is, you know, the Black Lives Matter and all that stuff going on, the protests and the awareness and everything else. And so my first comment is, please don't mistake mine and Gary's and Adam's jumping right into the business discussion as any indication of how we feel about those things. Not for this group, but I have heard of that feeling being out there that, okay, you know, you didn't, the participants or that were on the call, whether it was a video or didn't have anything to say about that. So I just want to point that out, that is not our intention, that we're just jumping into it because we respect your time. And this is for a specific purpose, this discussion for the next, you know, from 11 o'clock onward. Secondly is that, and this is not anything that is new as far as frustrated employees and others, but you know, I encounter all the time where that written signed employment agreement that has that non-compete provision in there somehow is missing from the file in the filing cabinet in the office. And so, not to impute ill will on anyone, but you need to be, as owners, protective of your information and not assume that just because it's in a filing cabinet at the office, like the calculations that you did and everything else, that you need to protect yourself not only from the government, and when I say protect yourself, being able to validate your calculations, but also from the perspective of having, let's say, and I've said this at least once before, a disgruntled employee who wants to wreak havoc on your business. And what is the most convenient way to do that? Well, you're holding a bunch of money and you've made some certifications to the federal government, and you know, they now are a whistleblower and they go inappropriately and lying essentially that you got some money that you weren't supposed to get. So I would suggest that we've been talking about documentation, but keep it safe, whether you offload it and back it up to the cloud or to a separate drive that goes wherever. There's also the issue of, potential fire or things like that. So just be mindful of that. Those are real issues that come up in real life, at least for me and my clients on occasion. So just think about that.
Yeah, and to piggyback on that, and I know we're still on question number 1. Gary's going to get antsy since he's on his vacation. Right? But I had a call before this call from a client, and again, I think they call me because they don't like what the lawyer would say a lot of times, Jack. Today is my lawyer bashing day, I guess. Just kidding. He had an employee that violated on the weekend social distancing. It's like CDC guidelines, hanging out, on a Florida beach, right next to somebody else, and got coronavirus. Didn't disclose that they traveled despite, the waiver, like that saying you haven't traveled, that you have followed the guidelines, that you haven't been exposed to it. Didn't follow the protocols that this employer had set place in the workforce, to the extent that the person was hanging out in the break room with another employee, even though the break room was shut, took the mask off, fortunately did not infect the other person they came into contact with. But now, we've got a group of employees that all want to go home. Like, I'm not belittling this at all, but they all want to go home because they've been potentially exposed to coronavirus, all because one employee didn't follow what the employer had established, which is really no different than the procedures that I've got in my damn employee handbook, and now are mad because they think they should get paid under FMLA. Wow, what a conundrum as an employer on that one. It's like, you didn't follow the rules that I established, infected my workplace, put the business at risk, and now want to get paid to stay home. Yowza.
There will be more of that, definitely, as
Yeah.
people are coming back into the workforce, and whether it's on the front end asking for some sort of hazard pay, premium pay, essential worker pay, whatever you want to call it. So there's that, and then the after effect, if someone does get it, and then they presume they got it at work. I mean, that seems like, okay, kind of very direct potentially.
Yeah.
Mama never said it'd be easy being a business owner.
Yeah. Question 1B. No, I'm just kidding.
Yeah. Now we're on 1B. So next scenario from David Still. Wanted to share, I've also recently met with 2 different groups that received money from a big bank based on using 1099 contractor payments in place of payroll. Big dollars. I'm worried that these people might have to repay the loan or worse. I'm sure there's no easy answer, but wonder if you've seen the same. Any comment from any of y'all?
I don't know if I have any direct experience other than just what I've heard on these webinars from questions being asked, but I think you're going to get stuffed on that, and you're going to get stuck with a loan at the end. I mean, I don't see another way around that one. The bank messed up, but they can't violate the law or the guidance now. So I don't, unless they do some type of safe harbor for the banks. Like what they did do, I think, is they made a safe harbor that basically said you didn't have to give the money back if the bank screwed up the calculation. And in fact, they went the other way, saying that you could get more money if the bank screwed you on the calculation because they didn't include self-employment income for partnerships. You could go back to the well. So that generally is giving you, I think, a pass on the money that you got or could go back and get. But when it comes to forgiveness, man, I don't see him forgiving that. I mean, I could be wrong, but I just don't see that happening.
I think there's a point in time where the feds clarified the difference between being able to keep independent contractors in the number in the money essentially on behalf, as an employer, on behalf of those independent contractors. But then they said, no, they're on their own and you need to go and tell them to go take care of themselves. I have clients who were very early in their application process, and they followed the rules as they were stated, ambiguously, obviously, and they received money that was based on a head count that included independent contractors. And so he's in the same dilemma in a sense that, okay, what do I do? And it's like, and he wants me to tell him, oh, it's okay, you can use the money because that was the rules before. And there's some that believe that that should be the case. But I think that at some point, that when they made that line of demarcation and then said, no, independent contractors are not included, if you included those in your count, then I think there's a potential problem. I think that it's not fraudulent necessarily because you have an opportunity to fix the problem with respect to the forgiveness or giving the money back potentially. And then, but those who did get money based on the proper formula, I think they also will have an opportunity for penance and to give the money back too. So, you know, I have not seen where that is clear as what the instructions are in that respect. But I don't think anybody at this point can say, well, yeah, it's okay, you can keep that money if it was received based on a numerical, on a number, on a formula that include independent contractors when you ask for the money, when you receive the money, or when you give it back.
Yeah, and I think in this particular instance, you know, I'm sorry for saying this, but the Treasury had actually issued guidance prior to, I think, April 3rd, which was the first date that you could apply for loans on the independent contractor question. However, it was written in government ease. So the first, I mean, I knew that you couldn't. And about half the bank, well, actually more than half the bank applications that we looked at knew that you couldn't. So when I would get calls from clients saying, hey, my bank's telling me that I can use independent contractors, I think you're wrong. I'm like, trust me, I'm right. Just give it time and don't do it. You know, then they subsequently issued guidance in one of the FAQs that said, you know, to avoid doubt, here's what we meant. So this is going to be a really tough one because I think the Treasury would point back to, nah, we told y'all you weren't able to do that even before you could make the loans, and we're just sorry that you couldn't interpret the language correctly. And falling back on the argument that, well, the bank gave me the money, just doesn't seem like a good fallback provision to sit on.
All right, third scenario in this one, and then we'll move on, is perhaps not so unusual, but interesting. I've been telling Schedule C folks that the 24 weeks will more than wipe out their loan and they'll end up with 100% forgiveness. Do you agree?
Yeah, I think that's the whole point of the 24 weeks.
A couple comments too that have come in. First of all, this is from Joe. He said, yeah, we paid 4 people that didn't follow protocol and sat home for 2 weeks, back to the COVID deal. And then
that's why they call you Papa Joe.
That's right. You're a big papa and a good papa. That's a good thing. Speaking of papa, if you guys hear any screams, I've got a 2-year-old, a 5-year-old, and 7-year-old grandsons running around here, which is why I'm cordoned up in the quietest room of the house.
Good for you.
Okay. The other thing, this is from John. So to confirm, and this is related to Main Street Lending Program, in order to qualify for Main Street Lending Program, my company needs to be classified a mid-sized company with more than 500 employees. Can you clarify?
No, I don't think the employee count, Jackie, correct me if I'm wrong. I'll try to solve for time so you can look at it, but I don't think the employee count actually matters on this one. I think rather it's just an upper limit. I mean, it generally is intended to be for larger organizations based on the fact the minimum loan size is $250,000. So, you know, by default, you've got to be of a certain size to be able to support a $250,000 loan. So just, you know, if we used round numbers as an example, I think these are even though the slide said 4 years, I think it's a 5-year amortization schedule. Let's just assume that that's $50,000, keep it really simple each year. That means that your EBITDA, to afford the payment under kind of a 1.25 times debt coverage ratio, you need to be, $50,000 divided by 0.75, whatever that math is, already in EBITDA. So, out of the gate, you really need to be at, call it $100,000 kind of minimum floor, probably EBITDA, before you're even going to be able to look at one of these. So it just means that they're meant for businesses of a certain size. And then there's an upper threshold. I can't remember what it is, but I think it's like 3.5 billion in revenue or something. It's pretty high in terms of the upper size.
So I didn't need that much time stalled, but thank you for doing that. I think it's a logical interpolation of kind of the different loans, the PPP and the Main Street, but I think it's incorrect in a sense that the upper limit for PPP is 500. So you would think by implication that means 501 and above for the other loan program. But to a comment that our discussion that we've had previously earlier today is that there is overlap between them, and I think that's one of the overlaps, which is it's not based on employee count with respect to Main Street facilities, but all the things that Adam just said, the logic behind and the parameters and the amounts and things like that would lend themselves to be in a different bucket than probably most of those that are on the PPP side of things.
Yeah, and there's something that came up in an email because it wasn't on a previous webinar, even though it really was. Could I take PPP money? Does that exclude me from taking Main Street money? The answer is no. But to get to that answer, when you're looking at the term sheets, you just got to read the whole thing. I mean, it's only 3 pages, so it's not super hard to read. But there is a provision in the requirements or the term sheet from the Fed that says, you can't have received stimulus under the CARES Act. But then a subsequent footnote says, to avoid doubt, you can take PPP money and Main Street money. So what they're really talking about there would be, like airlines or other companies that were also in the CARES Act that had direct federal grants specific to that industry. That's really who I think they're trying to single out on this is like, look, guys, you can't take our grant money and then also take our loan money too, when we singled you out as an industry we're trying to support.
All right, a couple more questions here. One from Bill. Has the limit of 8 weeks of 2019 salary for owners been changed when computing PPP forgiveness?
Nah, that hasn't changed yet.
But I have heard from my guys and girls internally that there's a discussion about that, and it actually has a name. And it may be part of the Expense Protection Act. And I mean, that deals more with the hit on the deduction of expenses if you're getting reimbursed for them. But I think that's all part of that as well. But there continues to be a lot of discussion on the legislative and implementation side of things with respect to calculations. But as we talked about previously, that has a pass-through waterfall ripple effect through a lot of different things once you start manipulating the formula, essentially.
All right, this one I know we've covered before, but it might be worth redoing, just addressing again. This is from Brad. Can PPP funding be used to pay employees less than 100% of their lost income? And if employees were paid 100% of lost income under the original PPP funding, can the employer reduce the percentage under the Flexibility Act extension of the program?
I'm trying to extrapolate an interpretation here, but, I think effectively this is saying, can I pay somebody less than 75% of what I paid them before? I don't think so. I think you're pretty well stuck with that, regardless. So maybe whoever asked the question can clarify a little bit more what they're trying to get at, or maybe provide a specific example. But I think, no matter what, even if you surpass the 15,385, you still need to be at 75% restoration. They didn't do anything with that to my knowledge. They did give you some relief on hiring people back, but in terms of restoring salaries, I don't remember seeing any carve out for that. That seemed like that still stood.
Yeah, and his question specifically was less than 100%. And, you know, what you're saying is as long as it doesn't go below 75%, you should be okay, correct?
Yeah, we think so.
All right. This is from Bob. If we file for forgiveness after 8 weeks and an item or two gets rejected, prohibiting us from 100% forgiveness, can we then cancel our request and simply file under the 24 weeks program?
I think that's going to be bank specific. And at the same time, I'm speculating, but I see it being one application where you just say the date range where you had expenses, because the only thing that was really specific to 8 weeks, I believe, and Jack, please keep me honest, was to the repayment terms. In that if you got a loan before the act was passed, you were still under the 2-year terms. But if you got a loan after the act was passed, you got 5-year terms. But everything else, I don't recall any specific delineation between you had to pick this one or this one. In fact, I think we already covered that we think it's going to be just, 8 weeks up to 24 weeks. So I don't think the rules are actually super different other than those repayment terms.
Yeah, I think we're going to see more about interpretation of that, because you do have the 8 and 24 weeks come. There's also a line of demarcation of when you got the loan proceeds and, is under and then implementing the various changes. And so making sure that people follow what the rules were at the time, but then giving them the option. And in some cases it is, you have to negotiate with your bank in order to extend or modify certain terms of the loan that was granted under certain terms and conditions. So hopefully there'll be a roadmap as to the choices that you can eventually make, but the implementation of the legislation is still in process. I mean, we have not received really much from Treasury or from the SBA, which is, okay, now we know what Congress said, so here is all of the FAQs and interpretations and everything else that follows from that yet.
Yeah, the good news is a couple weeks ago they said this is a priority, so just stay tuned. It's a priority. Here's the second follow-on question from Bob, and that is, if we're not quite there after 8 weeks, but we're clearly there after 12 weeks, can we file then, or do we have to wait until the full 24 weeks pass?
I think it's going to be once you spend the money, you would apply, assuming the bank's ready to receive the application.
Okay, this is from Bert. We were funded with an EIDL loan last week. What special stipulations apply to these loans or requirements? Am I okay in using this loan to retire another higher interest working capital loan?
Not specifically. So like it's not supposed to be used for, this is off the top of my head, but it's not supposed to be used for refinancing purposes or new equipment purposes or expansion. I mean, it's really meant to kind of keep the band together. All that said, man, I don't know. I mean, if you're already paying off your debt as the normal course anyway, it's like, I don't know how you're supposed to prove, well, these funds, like, in other words, if you use the EIDL money to pay your term debt, and because of that, you're not using operating income to pay your term debt. So now you're building up cash, and you use that to pay off a high interest credit card. I mean, I could make a case that was really refinancing, but I don't know how what are you supposed to do with that information? So what we've advised clients is that, look, pay off debt as you would normally pay off debt as cash is available, but otherwise consider keeping the credit facility intact, because what they didn't want to have happen is that you got the money and then the bank turned around and said, well, that's cool. Now if the government's your lender, we're not your lender anymore.
Yeah, I would agree with that. So two add-ons is keep the funds separate and stay within the parameters of the permitted loan usages. And for those that are on the fringe, like how Adam just essentially reclassified paying down debt versus being a true operational cost potentially. I mean, what do you do in a scenario where you have a machine that dies and it's a huge part of your business, an oven or something, and you need to replace that, and you essentially are taking out a loan in order to buy that piece of equipment. That may be different because that's the purchase of an asset in the normal operation of the business potentially. But so you can see where a lot of that may fall into the gray area. So going back to something we've been saying from the very beginning, which is keep the money separate, do what you were normally going to do with your operational cash flow, and be careful about anything that seems like you're paying down debt other than the normal servicing of debt. And I would say things like income expense and that kind of thing, that has a special category. But as far as paying down principal, paying off principal, you need to be very careful what you do with funds from the government with respect to that.
Yeah, and I think this is the opposite of what we would normally say outside of any other circumstance, but at the same time is your ally on this one. So, when for a lot of our clients, I mean, they've been blessed in the fact that their revenue hasn't suffered significantly. So they've actually got more sitting in their bank accounts than they've had ever. So a lot of them have had this question, well, when can we start paying down debt? And my thought on that is, look, man, if it costs you an additional, $15,000, $20,000, sure, that's not chump change. I would take it if somebody gave it to me. But at the same time, the downside risk of, man, if you screw that up is pretty substantial. So I think waiting on repaying other stuff off that's higher interest with either your forgiveness money or EIDL money, it doesn't really matter. It makes sense to really be thinking about that in the fall. There's no just take the interest hit right now just to make sure that you got further clarification as kind of a CYA, is my own opinion.
All right, next question. We've got 8 more teed up, and I'm sure we'll probably get a few more. But this one says, if you have to get a fully audited set of financials for your year end, will BGW be putting out any notes in the audit about PPP if the company did receive PPP and has already received their forgiveness?
Yeah, so GAAP required some disclosures around receipt of PPP funds as part of the 2019 financial statements, and what the plan was related to coronavirus. So although GAAP hasn't pronounced anything, when I say GAAP, the FASB hasn't pronounced anything around what the disclosure should look like in 2020, to my knowledge, and hopefully none of my attest partners beat me over the head and say, well, yeah, we did. You just didn't know about it, dumbass. This happens to Jack all the time with his employment law attorneys. If you're on gallery view, you can see Jeff laughing insanely at me right now.
Yes, yes, it does.
My assumption is you're going to have a disclosure that looks something like, the company received X and this amount was forgiven on this date, or alternatively, received X and it's anticipated that the amount of forgiveness will be X, but hasn't been processed yet. So I would see some type of disclosure like that.
Yeah, and I will say that also, so I represent franchisors and they are late, some of them are late to publishing their 2020 updated disclosure documents because their auditors had to put stuff in there, felt like, and they're like, yeah, we don't necessarily want to, everything's fine, and it just makes us look like something's wrong. But yeah, it's been a challenge on in the franchise world as well, and getting out current disclosure documents. So there are auditors that are out there requiring that, or they won't issue their letters.
All right, next up is a scenario where my business had 5 employees pre-disaster. As of now, I have only rehired myself. I'm going to use the 24-week period as the 8-week period is almost lapsed. If I wait until 6 weeks before to rehire the rest of my employees and apply after the 24-week period has elapsed, am I eligible for full forgiveness, even though I only employed 4 out of the 5 for the last 6 weeks?
It's really going to depend on the reason why you couldn't bring the other person back. So you'd have to fall under one of the exceptions associated with, either they turned you down even though you offered it, health concerns, still experiencing a business disruption. Even though, technically you could probably get away with it, using this as an excuse to right-size the organization because you were too much of a chicken shit to right-size the organization pre-coronavirus, probably not a good strategy. Sorry, I guess I'm a little bit feisty today.
You are feisty today.
I thought there's not this.
All right, next one. Now that Flexibility Act has passed, does it change anything about the $15,000 cap? I think they're talking about the $100,000.
Jack may know more on this one based on the fact that he's got government moles. But it, really could go either way. Either that it could triple or it could stay the same.
Yeah, like I said before, they've even said is the number instead of 15,383 or whatever it is, it's 46,153, which is 24 divided by 52 times 100. So, it's we don't know yet. So, sorry.
Take solace in the fact that it's a priority from the government. All right, next one. Sorry.
Yeah, can I go back to that though?
Yeah.
We really could see it go either way. And at the same time, I don't think the intent was to have you employ 1/3 of the people that you employed previously, but pay them all more. So, I really would try to spend the same amount over 24 weeks, like assuming the 15,380, like model it out 15,385 over 24 weeks to see where you get to. Because chances are, if you can't get to that, you got bigger problems you should be thinking about.
All right, next one. When should a company put the PPP transactions on the books if forgiveness is a ways out from being completed? If forgiveness runs into 2021, but it was all spent in 2020, do you keep it on 2020 financials or go into 2021?
I think on this one, I'm speculating. I'm guessing there's probably going to be a book tax difference. So for book purposes, it's going to be, it's going to be similar to, litigation expenses or litigation, recovery. If it's likely, it's probably going to go on the books as an accrual, in this year. But for tax purposes, assuming they don't change anything on the expense side, you'll probably get the benefit of deducting the expenses this year, but then you're going to have to accrue it, or you're going to have to back it back out the next tax year. So there probably would be a book tax difference on that one.
Next one's up is, can we use the safe harbor provision FTE count if our sales were impacted due to COVID and haven't returned to the same level?
You'd have to, it's supposed to be, and Jack will keep me honest on this one, it's supposed to be related to other factors in the environment that mean your sales are down other than you just suck. So, you kind of would need to make the case for that, I suppose.
Yeah, and I don't have, I had a printout of kind of what my cheat sheet, and it's at my home office, but there was, what we talked about the other day is the exemption on rehiring employees or bringing up head count, which is kind of where this question is going towards, which is, you know, the first prong was there, but then, you know, not being able to hire due to safety requirements, unable to return to normal operating levels, and those kind of things are part of now the formula for exemptions and not getting dinged. And so, but it's all COVID related. So it's not necessarily, I think people are looking at this as a change in revenue that creates some sort of right or privilege in the formula. But it's really related to the hiring, rehiring of employees, and not being able to do so for other reasons is really what the focus is with respect to that discussion on that exemption as far as revenues and things like that.
So a point of clarification from Scott, FYI, the loan term is 5 years, and this is on a previous thing, but while I see Scott's name there, he sent a note asking specifically, and I think this was maybe in response to one of our social media posts about this particular webinar, but I think the question that he had, if I remember right, was, do you know any banks that are actually participating in Main Street Lending Program? And honestly, I don't. Adam,
the answer is no. I mean, I got my first question the other day from a bank, which I owe her a response. I apologize for. I probably should have done it on the call, but I did not. So I don't know of anybody yet. I've had a few clients that have said, hey, we would like to do something under this program. What do you think about it? But it was not, hey, my bank's chomping at the bit saying, you know, let's do it. So I don't know of anybody that's doing it yet. But, you know, I do think that if you are a bank, there is, just like with PPP was an opportunity to be a first out of the gate resource. I do think there is a good opportunity here to get something on the books and really win over some people that might otherwise be dissatisfied.
Yeah, you raise a really good point. And again, I don't know of anybody specifically that's jumped on that bandwagon yet. I've heard two different things. One is banks that are very wary of getting stung by the government. And that's why, from what I've also been hearing about, why there may be still 130 billion left in the current tranche of PPP, because they're concerned about getting stung. Whereas on the other side of that, and these are even some of the smaller banks that really ran circles around the big banks, but I would also say I know plenty of commercial bankers who had smaller banks behind them that were pretty aggressive in doing these PPP loans, and they've won all kinds of additional business, even though those commercial bankers didn't get credit from as part of their quota. A lot of them didn't on PPP loans. So I just think that's interesting, and I agree with your point there, Adam. So next question. Hey, can you guys go over what happened with PPP FA since June 10? What was answered? What uncertainties remain? What I would say is we've got a few hours worth of details on those in our current BGW CPA YouTube channels. Anything that you guys want to hit on highlights about that, though?
I mean, there's been zero update other than the Treasury and the FDA issuing a joint statement saying we're going to get to it. You got anything different, Jack?
No, the same. I mean, there's speculation as to certain aspects of, you know, what does it mean? So, for example, an open-ended question that hasn't been answered, which seems logical, that if you only hit 59% instead of 60, are you SOL? And logically, the answer would be no, but there has been no guidance as to, okay, if there is partial forgiveness if you don't hit the actual 60-40 ratio. So,
because it says at least 60%. You're right.
Yeah. Next up is from Robert. Does having an EIDL qualify or disqualify a business from applying for the Main Street Lending Program?
Not that I'm aware of.
It doesn't, but it goes back to the usage of the funds. There can't be crossover necessarily. So, you know, it's the EIDL, and it's the terms and conditions too. that you may be able to get more money under EIDL. But I mean, if the question is that is there, it's one or the other and they're mutually exclusive, I'm not aware that that's the case. In fact, I don't think it is the case with respect to PPP, EIDL, or Main Street in any of the Main Street programs, whether it's a new or an extension.
Yeah, and the other thing I'd point out too, I mean, for the people that, I just want to make sure that everybody that's listening is really clear that the Main Street loan, it's a big boy loan. And by big boy loan, what I mean by that is, it's 5 years, it's at a market interest rate, it is collateralized, and it does have a loan covenant. That's the opposite of the EIDL loan. So, if you're going after this loan, you better be real confident in your ability to repay it, because it is really a big boy loan. And it's simply meant to say, hey, banks, keep on loaning money when otherwise I know your gut reaction will be to not do it. I mean, you still need to show that you got a good plan to get them. When I say that, that's me speculating. You still need to have a good business case for it and have a good plan on how you're going to be able to fund it and repay it through your existing EBITDA.
Yeah, and I would say there's other, and I know we're at 12:01, but my comment about that is there's other scenarios too that you can imagine where if under this program, they're supposed to be the most favored nation status with respect to lenders. And so you may have a current lender, you may have no excess collateral that can be offered. So, it is essentially a traditional loan. So they're going to be looking for all those things, and they're going to want to be and required to be first in line, or at least on equal footing with your current lenders if there's already stuff out there. And in some cases, likely you are going to have to go to your current lenders and say, yeah, I need to get this money, and you need to remove yourself from being front in line to being second in line. And then that bank is going to have to process the fact that if you don't get that money, then they may be completely out. Or is this a way to infuse capital so that your business will continue to move towards success and be able to repay both this new loan and the loan that's currently in place? So there's a lot of moving parts in all of it. Whereas the PPP program was designed to throw money out there with little obligations if you use it for proper purposes.
All right, just as a reminder, it is a time check of 12:03. Anybody that's having to peel off of this, we will put this thing back up on the BGW CPA YouTube channel later on this afternoon. So thanks everybody that continues to join in this in these discussions. Hopefully they're proving to be beneficial. This is from David. One of our company-owned stores was open just before February 15, but didn't have a payroll run until after February 15. Is there any way for this store to qualify for a PPP loan, even though there was not a payroll for employees until late February? And I know Adam is going to answer this one, and he is wearing the "Oh Kale No" t-shirt. So make sure that you puff out your chest big with that one. So thank you, David. Take it away, Adam.
Yeah, there you go. Man, I think you're kind of stuffed on this one because you don't have any evidence to support the loan other than what was paid after the fact. So you'd have to find, I don't know, you'd have to find a lender that would be willing to do it. And I just don't know if the lender is going to take that kind of risk, because it is pretty clear in the guidance that it, look, if you were in business, if you don't have 2019 to fall back on for the application period, you've got January through February. There's nothing that says what happens after that. If you're a new business that started after that. And I could understand their reasoning for doing that. I mean, the reasoning for doing that would be, Gary and I get together and we start a company knowing that there's free money available, go and get it. And we never had a freaking legitimate business in the first place. I could totally see somebody doing that in the middle of all this, which is why they wanted to say, I think, that you had to be a legitimate business, legitimate meaning like really in existence pre pandemic to qualify for pandemic stimulus money. So I hate to say it, but I really think this is going to be a tough one. I mean, the only, I don't even, the only thing that you could do, in this case, since it's a company owned store, is to consider paying the employees out of another entity that either has not applied yet but would qualify or has the ability to get an increase, based on the fact they said, hey, if the lender screwed up the application, that's the only thing that I can think of. But even then, your employee count would be off. So I really think in this case, I hate saying it, but it's probably SOL, because I can't think of how the lender would even process the application because you've got nothing to prove what you paid.
Yeah.
Other than it happened after the fact.
Yeah, and I think part of that, some of the theory that I've heard is that, imagine a scenario that someone filed articles of organization or incorporation towards the middle of March.
Yeah.
And said, okay, but they really, and even if they had maybe an EIN, but they weren't really in operation, and they were like, I don't know if I should or I shouldn't. Then it's like, oh, if I get going, then I'm going to get some money. So I need to get going, versus it being a legitimate, as we said, as you've defined it, business prior to the pandemic. So I've heard that reasoning as well, that it's, that they don't want to give money away to people that weren't already supposedly hurting for that because of the business that it was already established.
Yeah, to quote Fat Tony from The Simpsons, you have to be a legitimate business, not a member of the Legitimate Businessmen's Club.
Wow.
Jack's really laughing now.
I don't think we've had a Simpsons quote yet, so we're expanding our repertoire, right?
A follow-on from David, and he said, even if we signed the lease before February 15, would that make any difference?
You still got the same problem. You haven't paid anybody. So that still falls back to Jack's scenario around, how do you differentiate between the people who are really giving it a go versus the people that just said, hey, thank you, free money, source of capital, bam.
This is a follow-on to a previous question. Since both of them were anonymous, I'm not sure which one it was, but said, if it was only because COVID has cut our sales almost to zero, does that count?
Yeah, again, I think you got to be, you probably need to really think through COVID, meaning like under a government order, unsafe. I mean, Jack already covered off on some of these topics.
All right, next up is from Scott. I have a client that has an S Corp with 2 owners who receive 1099 miscellaneous income. Are they eligible for PPP loan?
So, in the S Corp itself, the amount, assuming they're the only people, their W-2 wage would be the qualifying thing. If they didn't pay themselves a wage and instead they issued themselves a 1099, which they're not supposed to do, but if that's what they did, then they would qualify under the amount that they did under the 1099 as an independent contractor, which is the same as what they should have paid themselves in the frickin' W-2. So that's the only answer that I could think of.
Yeah, that's when I heard that, I was like, okay, which direction is that question going to go? So yeah, Scott, you may want to send your client to Ad and have a discussion about S Corps and owners and W-2 and 1099 income with respect to that, because yeah, I mean, it's clear that if they are properly employees, that's W-2, but it sounds like that as owners, they were paying themselves as independent contractors. So have you just shifted, has this client just shifted themselves outside of that? And so anyway.
All right, last question up. Any updates on 501c6 qualifications for PPP?
I wish, because I'm getting that question from various people, and there is not. And it is, I don't know what the holdup is, because there are so many. I will tell you that there are a lot of people working on it, putting pressure. I mean, imagine, all the chambers of commerce, whether it's national, state, local, and then the ethnic chambers of commerce, like the Hispanic, the African American, the Asian. All those are putting pressure and saying, wait a minute, what about us? We have staff that runs this for the benefit of the business community, and so how is it that we are excluded? And not justifying it, but some people, the argument has been, well, you support businesses that themselves are being helped with these programs. So why, they really don't need you right now. And I think that's so disingenuous. And I don't know who said that, but because it was an anonymous, I think, post on someone's discussion on one of these chambers of commerce, and said, well, we appreciate everything you've done, but we're not asking you for any help right now. Yet the chambers of commerce are the ones that are putting out information and providing, here's a link to this potential fund of money, to this fund of money. And they're trying to continue their programs outside of everything that they do with respect to, the protests and everything else, and supporting businesses. So I wish I could say yes, and here is the answer, because it needs to be answered and addressed, and it's just been seemingly put on the back burner.
Yeah, and I think I agree with Jack, and the delineation that I'd give is that I live in Davidson, so we're serviced by the Lake Norman Chamber, the Lake Norman Economic Development Corporation, and Visit Lake Norman. So all three do the job that's pretty similar to what the CRVA and the Charlotte, is it the Regional Alliance, whatever the chamber calls itself these days. And I apologize about that. I should know better. Well, the chamber does not take all our 501 C6s. The chamber is completely sponsorship, membership driven, whereas the EDC, off the top of my head, I think is about 75% funded by the towns, 25% funded by corporate sponsorships. Maybe it's 50-50. It's somewhere in that neighborhood. I was on the board. I should know that. And then Visit Lake Norman is funded predominantly through the towns and through tourism tax revenues. So I understand the argument of, well, we're going to disqualify across the board 501 C6s because there's already government funding available. Well, true, but not in all circumstances. So I sympathize with whoever asked the question that, look, if you're not getting public funding, you're really a business. You just happen to not pay taxes, but everything else about you're a business.
Yeah, C6s are definitely business, and it's having an impact. I mean, the chambers of commerce have had to lay off people, put people on furlough, and in some cases run really on skeleton crews from their homes. And so, and I know that's the case. And so they are the chambers are employers. They have responsibilities to their employees, and those employees in some cases have decided, this is what I'm going to do, and that is their commitment to the community, versus going into a truly private sector job where they might be making more money potentially, or get better benefits or better hours, or those kind of things. So yeah, I think it's shameful that it's still excluded and being treated differently than a regular business.
Well, it looks like we have no additional questions. And I just heard, instead of Fred Flintstone hearing somebody pull the tail feathers of a bird, I heard my 2-year-old screaming. So it must be lunchtime downstairs.
Yeah.
We'll see you guys on Thursday morning at same time on the same bat channel. And thank you again for both of you guys doing what you do. We appreciate it. Thank you for everybody that's tuned into this thing, and we appreciate you. Have a great day and a great rest of the week. Talk to you on Thursday.
Yeah, thanks, Gary.
Thank you. See y'all.
All right.